Roti Kapda Makan is a real thing in India. But a lot of people don't know about real estate debt as an instrument.
Real estate as a sector has also gone through a massive amount of evolution.
And what is Earnnest.me and why did you start Earnnest?
Many of the platforms stick to 10, 15, 20, 30 crore deals, right? We started with 40, 50 crore deals. Today, we really look at 100, 150 crore transactions. There is a desire for fixed income products which can give you regular income and not compromise your return. I think we are just marrying these three things.
Have you ever thought about going down the FRE route?
Despite all these market cycles, we have never lost capital on any of our investments.
Under construction is risky and there's no doubt about it, but married with the right expertise competing at you, maybe it's less risky for always keeping investor. Hey everyone, welcome to another episode of the Alt Investor Podcast, where we provide you the right knowledge you need to make informed decisions about alternative investments. I'm your host, Yashinta. For this episode, our guest is Ashish Khandelia. Ashish is the founder for Certus Capital and Earnnest.me, the latter being a retail platform to invest in real estate debt, earning anywhere between 14 to 16% IRRs. Ashish is probably one of the most experienced folks in the real estate investing and lending industry with over 20 years of experience. In his previous roles before starting Certus, he led the real estate businesses at KKR and Morgan Stanley Real Estate in India. But, enough hearing from me on this. We'll shortly hear from Ashish on his journey till here. I must say I'm particularly very excited about this podcast because we rarely have a chance to host high-profile individuals like Ashish onto the show. So thank you, Ashish, for agreeing to do this and welcome to the show.
Thank you. Thank you so much, Yash, for having me here.
So Ashish, let's get into this directly. Real estate is again a very exciting avenue for investment for Indians. Roti Kapda Makan is a real thing in India. But a lot of people don't know about real estate debt as an instrument. Before we go and delve deeper into real estate debt, let's start with your background and why did you start Certus Capital and then a retail investor platform like Earnnest.me.
Right. No, so Yash, I think so let me start with my background and that will automatically lead into the questions of Certus and Earnnest. So my own background for 20 plus years has been in real estate finance. I think by way of education, I'm a CA from Ernst & Young and then an MBA from ISB Hyderabad. And after that, between Kotak, Morgan Stanley and KKR, during these three different stints, I started as a real estate banker, then was a real estate private equity investor at Morgan Stanley Real Estate, and then basically joined KKR to build their real estate debt platform where GIC, which is the Government of Singapore Investment Corporation sovereign fund there, was one of our anchor investors. So, and over the course of all these journeys, it exposed me to all kind of real estate capital structures, from private equity to IPOs to mezzanine debt, and then building a lending platform in the form of an NBFC doing secured financing, right? So that has been the journey, and it has also been a journey where real estate as a sector has also gone through a massive amount of evolution. Because when we started in 2003-04 doing all of this thing, it was very early. Even foreign investment wasn't allowed at that point in time. 2005, it opened up. But soon after it opened up, massive amount of influx happened, which also caused a lot of bad deals to happen because there wasn't enough sector expertise and a lot of money chasing just before the global financial crisis of 2008, right? So, and that also led a lot of scars on a lot of the foreign institutional investors at that point in time. But then people who stuck after the GFC and, Blackstone, GIC are some of the examples who have been around, Morgan Stanley included, who have been around. They have basically then been investing and increasing their exposure on a consistent basis. And India is just a very long term. And now it is for many more, whether it is Brookfield, whether it has been Ivanhoe Cambridge, many people now, so it's so I think after doing all of these things, incidentally, I was lucky enough to be very early in these Like when I joined Morgan Stanley, they have just closed their first transaction where I was in fact the investment banker from Kotak, and they were starting to build a team here. So me and in fact my director of investment, Sahil, both of us were there in 2006, and now we are both of us here in Certus. KKR gave me an exposure of how real estate lending really is. And after doing all of this thing, I was at that stage that now, let's build something. There was enough expertise, there was enough market connect. And I just felt that the opportunity, especially when it comes to credit, is very large. We have seen a lot of foreign capital participation in acquisition of assets or build out of assets, whether it is offices, retail malls, or industrial for that matter. But there has been a much lesser participation when it comes to the core developmental part of the Indian real estate, which is more than 70% of it, right? Okay. And lending, a lot of that happens like that. So I think I find that there is a very large space and a lot of white space in that. And that's where we kind of position Certus Capital to begin with. So that's...
Why become an entrepreneur? I mean, why did you not continue at the same place, making it bigger?
That's just honestly a matter of personal choice. I have enjoyed building these businesses. Like even when I joined KKR, it was just a business plan. Yes, we had this comfort from GIC that they're going to be our anchor investors, which they ended up being. But it was just a business plan. I didn't have anyone for 5-6 months. So it was exposed to that, and it was an interest that at some point you got to try something of your own.
Sure. Okay. Can you, for the audience, explain what is Certus Capital? What do you do? You briefly explained it, but I think you handle the institutional side of it. And what is Earnnest and why did you start Earnnest?
Right. So see, I think when we started Certus Capital, I think the thought process was very simple, and it continues to be that like what we have seen in private equity. Private equity kind of predated real estate equity or real estate institutional investing by about 10 years, right? And between 1995 to 2015, quite a few professionals who have spent that 15, 20 years doing that, then they came out, multiples, Kedara, you have various examples like that. And we just felt that India should also have its own homegrown GPs, which are really experienced. They have that training. They have seen the best practices from the largest of global real estate investors, and create something which is very suited for the country. And that was the intent with which we started Certus Capital. And there also our initial focus was very clear. We want to focus on credit because that was a large space and a bit of a wide space, right? So with that intent, we have an NBFC license today. We have an AIF license today. We now have a bonds platform, which is Earnnest.me. And then all of that over the last 5 years since I left, or 6 years now, 2018, it has also been an extremely dynamic environment, a little bit more stable for the last 2-3 years. But 2018, there was an ILF crisis soon after I left. Then we got into COVID, then second wave of COVID, and which also shaped in terms of what we ended up finally doing at Certus Capital. The intent remains very simple. We want to be a very large credit player in real estate. We want to have very focused equity or special situation kind of asset management strategies in there. And early on, after I left and before we could have moved on to more investing our own capital or creating these investing platforms, there was this period in between from 2019 to 2021 where because of the market dislocation that was going on, we were doing a lot of advisory work. But that advisory work was highly specialized in terms of focusing only on 1,000 crore plus transactions and working with some of the largest global institutional investors. So we advised early on in Jan 2019 on a transaction where Oak Tree Capital bought 1,400 odd crore worth of loans given to Bombay Dyeing from DHFL. And that was one of the first transactions to kind of come out after the ILFS dislocation started, right? So we did about close to 9,000 crores of that business while ILFS and COVID-related disruptions were going on. And even after that, like one of the later transactions, we advised Bain Capital as their advisor, not the transaction advisor, on 1,000 crore investment that they did with Embassy Group in Bangalore, right?
Wow.
So I think our whole thought, so we had quite a first row window to all this dislocation that was going on, clearly kind of seeing also an environment where some of the NBFC, HFC kind of play that was going on between 2014 and 18 is going to get scaled back. And you will need some alternative kind of capital, which for a period of time was being promoted by these foreign institutional investors that I spoke about. But the genesis of Earnnest, which I think we feel extremely passionately about in terms of its potential and need, both from an investor point of view and from a real estate sector point of view, actually that came about at the end of December 2020. So effectively at the end of December 2020, we didn't had any thought of creating a platform like Earnnest, but we have just written an internal research paper, which was titled like something like a real estate sector staring at $100 billion gap.
Okay.
And it was a culmination of a lot of work that we did between 2018 to end of December 2020. It had some very simple conclusions. It sized the capital requirement for the sector, especially the developmental real estate sector, to be close to $100 billion over the course of the next cycle, which is 7 to 10 years. It also concluded at that point in time that we are at the absolute bottom of the residential real estate cycle. And it should have a multi-year cyclical uprun over the next many, many years. And the third conclusion was that for dealing with this kind of a capital gap, you really need to mobilize domestic capital, because foreign capital is too expensive, applicable in too limited places, and we have seen all of that firsthand, both as a part of our earlier jobs and what we did in advising on the 9,000 odd crores. Yeah. So these were the conclusions. And that's when we kind of said that if we are so convinced about this was carried by VC circles, so it's kind of in the public domain. It is on our website. So if anybody wants to read it, it's available. So I think then we thought that if this is our conviction, why don't we create something which will squarely try to solve this opportunity and also the need, right? And that's kind of led to the creation of Earnnest, where we said we need, I mean, at a larger level, we maintain, and several experts have, India needs significantly more development in the fixed income markets and in our bond markets. Today, 98% of our bond markets are AAA and AA. Right? We need that evolution any which way. So what has happened to equities with the advent of mutual funds 30 odd years ago? I think fixed income needs to go through that journey. And therefore, we keep going into this TINA issue of there being no alternative outside of equities if you want to make any decent return. So if there is a platform or an opportunity which is transparent enough, easy to transact, and there is an expert team which is managing it and which is also putting its money. From A1, most platforms don't do it. But we are very clear. A1, we invest 100% of our capital to invest into an opportunity. And then always, throughout its life, we maintain a significant exposure of anywhere between 5 to 10% in that opportunity. Like any other alternative investment manager should be doing as sponsor capital in the funds. So we are very clear, we always do that. Right? So the whole idea was, if we can do that and then make it simple and easy and a very digital, simple journey, we may be able to create a market for real estate debt. And that's how Earnnest was started in 2021 in terms of its build out, and actually went live in Jan 2022.
But Ashish, this market must be, I'm sure the real estate debt as an asset class is a big market in India.
Right.
Amongst retail investors, it will be very, very small. And I'm 100% sure it will be very small area of focus for you as well, right? With Certus also into the picture, because the kind of volume, I don't know what kind of volumes are you doing via the platform, but I must assume, knowing other competitors in this space, the volume is not huge, right? So what keeps you motivated to, invest behind it?
So I think, yes, it's very simple, to be honest. In fact, today we spend practically 80% plus of our time on just building Earnnest, And of course, there is a roadmap to launch an AIF very soon. We have an NBFC license, which at some point in time we will grow into maybe supplier financing and etc. Not in the other sectors. But I think it's kind of very simple. The point is that there is a fairly deep expertise. We have a more than 20-member team, almost 25-member team now. The expertise that is required to do this is high. So the barrier to entry for this product class is high, actually, right?
Absolutely.
And I think compared to many other platforms, we actually don't mind going after larger deals. Many of the platforms stick to 10, 15, 20, 30 crore deals, right? We started with 40, 50 crore deals. Today, we really look at 100, 150 crore transactions, right? Which give us a little bit of an economy of scale and better risk reward also, right? So, give you an example, the run rate that we are seeing this first half is 6x of what we were seeing. So 2 years it took to establish, to kind of create awareness and everything, completely get a well-oiled machine in terms of doing all of that. So our whole thing is that it's at least a 1 lakh crore rupee market per annum.
Okay.
Right? And there has been a significant shake-up in terms of availability of this capital from traditional lenders. Like NBFCs, HFCs, which used to account for 55% of disbursements in 2018, now account for 15-16% only.
Wow.
Right? Yes. And that is just a function of how the nature of this market is. A lot of things, it requires flexibility within the same transaction. You have components which some NBFCs can do, cannot do, etc., etc. Right? So it does need that expertise. So we just see that, and it's a growing market. I mean, just by our demographic, there is an X amount of growth, irrespective of the cycle that is there. Like cars. I mean, cars is basically a category which has a certain amount of growth every year, whether it is a slow year or a... So that's the same thing. Housing is actually a consumption product, not so much an investment product at the end of the day, right? So we just feel that it's a very large market. Retail investors in general, I mean, our ticket sizes are not actually exactly retailish. Our minimum ticket size is actually 10 lakhs. And we have deliberately kept it that way, that people who can understand the risk, appreciate the risk, they should only enter. Over a period of time, we may bring it down as the product knowledge increases, right? And a lot of our investors are actually much higher ticket sizes running into crores, right? So the whole thing is that there is a need at a market level. There is a desire for fixed income products which can give you regular income and not compromise your return. And there is a desire that all of that can be done in a fairly trust-based and a simple manner. I think we are just marrying these three things. And what keeps us motivated is the size of the market on both sides. On the way alternative investing is growing in India, the way real estate is growing, and therefore the need for real estate debt is growing.
Perfect. No, very, very, very interesting. 1 lakh crore is a sizable TAM to address. So, talking about real estate debt, can you, let's say, give an example as to at which point in time, let's say, a developer would go and take out this debt, so that people understand what are they really trying to finance or why do they need the debt from? Just a very basic case.
Yeah. So I think the way we look at it is less driven by at what point in cycle of a project we come in, more driven by other factors. Most important factor being the quality of the developer. And while we have had a very patchy past, right? And that is the reason the sector is giving as much return as it is giving. I can promise you after 3 years, I can not deliver the same return. We will be at least 2-3% lower because as the discovery happens, the risk premium will go down. But it's the character and the quality of the developer. Now we have enough in our history of that. So he needs to have the expertise, corporate governance, and a clean track record in doing the business we are trying to fund with him. We don't take any kind of approval risks which are not as per the law. So a lot of real estate projects in the past have kind of predicated themselves on getting some special permissions and approvals and all that. But if it is not part of the development control regulation as a set code, we don't want to take. Most of our projects have actually been funded after they already had RERA approvals in place. Okay. Or the RERA approvals were very, very close by. We funded and it happened in a 10-15 days time. So we could take that kind of a call. Or it has been funded to developers who are very large already in size. Like one of the developers funded CASA grant for land acquisition, so which is as early in real estate cycle as it gets. But he is a pretty large developer already filed for IPO. Right? So, and then we generally look at that the overall life cycle of our investment or the underlying project should not exceed 4 to 5 years max. So which is within the cycle horizon that we are underwriting today, right? So I think we look at those key factors, and generally speaking, on average, when we kind of triangulate these things, the average life of a transaction will end up being between somewhere around 2 to 2.5 years from starting to end. Average will be that. It may be running from, let's say, 0 to 4 years, but it starts paying you the principal back after 12 months and so on. So in average, it will be like 2.5 years, which I think a lot of our investors quite like. It's a reasonable duration, not too long, not too short. If you have been able to lock in a return of 15-16%, I mean, they want that locked in for that much period of time. Right. So I think we kind of look at those factors. We are very, very focused on the process that we follow. The diligence agencies, for example, that we use in assessing are pretty much the same that are used by some of the largest of institutions, whether when we were working there or when we were advised.
Sure.
Right. So that I think is the other cornerstone of the process that we follow.
Okay. A lot of your competitors in this space, at least, or some of the bigger names, are going down the fractional real estate route. I don't know if they are your direct competitor, at least they are on the real estate segment when I talk about alternatives as an asset class. And SEBI has also brought in the SMDs regulation, so they have also officially recognized that asset class and want to regulate it. Have you ever thought about going down the FRE route, or you think debt is still a large enough opportunity to solve for, and hence FRE doesn't make sense?
So it is less about whether it is making sense or not making sense. I think FRE has its space, and it will also grow as an asset class. And with the regulatory framework, I mean, of course, the regulatory framework itself will go through an evolution. Even in REITs, it went through an evolution, right? They'll keep becoming more and more efficient, right? I think there are two things here. One is that the sophistication that is required to run a real estate debt platform versus an FRE platform, it's just kind of a little bit higher. So therefore, barrier to entry for this asset class is higher. Investors also take longer time to build trust, and you need to have extremely high quality and experienced team, which thankfully we have because of all the institutional background that we have. So many of our investors keep coming and inquiring about FRE. There are two things. One, there is an alternative to FRE available, especially if you're a large and sophisticated enough investor, which is REITs. REITs is a much better, much evolved version of an FRE. FRE allows you to look at a single asset and take a view on that, whereas making an investment into a REIT requires a little bit more sophistication in terms of understanding the price and where you should enter, etc., etc. So it is on our radar. It is not an immediate priority, right? If we want to do it, we want to do it very, very right. And today, I think our mind share, our energy is on building the real estate debt market. But pretty much the entire infrastructure, everything that you need to do is kind of in place. As a group, we already have AIF and NBFC license, so we know how to be a regulated entity per se, right? So when the time permits, we will certainly explore this and add it to our product.
Talking from a developer point of view, let's say talking about Hirananda, do they also do real estate debt? I mean, do they take on real estate debt, and can they also enter into FRE? So I'm trying to understand from my perspective, FRE comes into a very end stage of life. When the product is almost ready, you want to sell it, you sell it to a couple of investors. Whereas real estate debt comes even before the final product is finished, sort of construction financing. Is that notion correct, or there's more to it?
I think at some level that notion is correct. FRE is basically a built asset, and therefore the return profile is very different. I mean, in our product, net of TDS, you are generally getting in hand 12-13% on a quarter-on-quarter basis. In most FRE opportunities, you really get in hand 5.5% net of TDS, etc., everything. And then the balance 5-6%, 8% will come through capital appreciation as and when that exit finally happens, right? So very different in that kind of sense in terms of, in our case, that return is a fixed secure return, secured by the underlying assets and everything of that sort. On the other end, in a typical FRE thing, you are really taking the equity bet on where that market will grow and where the capital appreciation will happen. Both are slightly different kind of risk reward profiles. yes, a lot of stuff that we do, there is underlying construction risk in that, and which is exactly where our expertise coming. What we are doing today through Earnnest is exactly what we are been doing for 15 years. Like since 2009 onwards, where we had been in any decision-making capacity, despite all these market cycles, we have never lost capital on any of our investments, whether it was in Morgan Stanley or KKR or Certus or what we are doing on Earnnest.
You answered my next question already. So, pretty impressive. Because under construction is risky, and there's no doubt about it. But married with the right expertise, from people like you, maybe it's less risky for average eating investor. Because some platforms, FRE platforms as well, which are not regulating or don't intend to go into the S&P regulation, are also selling under construction villas in Goa or Munnar and all that stuff. Where developers have run away and people have lost money.
Right.
So it can happen in FRE as well.
Yes, I think the difference is that, see, like when we do secure lending, and that's how it is done. There's a lot of control over the project. So I mean, the difference in a typical FRE versus we will be generally 2 to 3 times collateralized in terms of cash flows. The money that the developer has to make after we exit is quite significant, right? Any opportunity that we present shows that very, very clearly, right? There are extensive escrow controls that are exercised by the debenture trustee through our assistance, right? Which ensure all the money needs to come into that project. And these are the same controls we were exercising at KKR or in various other deals. So it's not that it is something new that we have created for Earnnest. That's just how it should be done. And every unit is mortgaged to us through a proper registered mortgage. So when they need to sell that unit, it generally has a minimum pricing at which it can sell, or they have to bring in that money. And every unit they have to sell, they need to take an NOC because it's mortgaged to us. So they can't register that unit without that NOC. So there is a very watertight control on a lot of these things. We have 2 external independent monitoring agencies involved on every project, and we have a large internal team, that does this monitoring. And there is a lot of our own capital, personal capital, team's capital that is invested in each of these opportunities. So we are closing a 100 crore deal. Day one, we invest entirely that 100 crore from our own balance sheet.
Wow.
And then other investors participate alongside us, and we generally will end up keeping 5 to 10% with us as a team throughout the life. So I think we follow the very standard principles of asset management. Like a AIF fund requires you to have a 2.5% or 5 crore as minimum participation. We generally go beyond those norms when we are doing these transactions.
Wow. Okay.
Because of all of these things, there's a lot greater control about ensuring that development will see the light of the day.
No, got it. So when you say you take, let's say, project as 100 CR and you have taken it on your books, and then you're downselling it on the Earnnest.me platform, I'm assuming the rate at which you finance is, of course, a higher rate because you're putting in on your capital front and you're taking on higher risk. And then you're downselling it to retail investors on assuming the spread between how you, as a platform owner, will.
That's right. That's exactly right.
Sorry.
Yeah. No, so that's exactly how it is. We lock in the transaction, we do all the hard work, and we continue to manage it.
Sure.
So, and that spread is basically what is our income.
Sure. And let's say all these opportunities out of the platform. I know the platform is not for VTC right now, but what other kind of regulatory, things that are there that we need to look at? One is RERA, of course, or whether the project is RERA approved. Are there any SEBI or MCA laws that you need to comply as a platform?
So I think more than as a platform, it's just standard business practices or standard business things which touch various different regulations and laws and all that stuff, right? Yeah. So in that context, whatever are the laws that a company needs to follow in terms of issuance of those bonds, how many people it can offer to, et cetera, all of those are properly followed, right? Whatever are the regulations that are required to be complied by a particular project, right? We have extensive checking and diligence on that happens, which is all absolutely institutional grade. Like let's say most real estate projects, they need to be thoroughly vetted from a title point of view, right? So again, all of that is properly checked, right? We do our entire business in the form of dematerialized bonds. So again, any investor who invests into this thing, he gets those bonds in his demat account. So there isn't like holding some share in an LLP, which is not really with you. You just have maybe some photocopy proofs of it, and you don't really have the right to vote on it. All of that is enshrined in the entire. From that perspective, this bond works like any other bond in the country, right? Where there's a proper constituted debenture trustee. You as a debenture holder has the right to vote. If tomorrow there is a vote called for, you have the right to vote it the way you want. We don't try to control it, etc., etc. So I think all of that is kind of well taken care of with the involvement of our own team, the developers team, and a lot of third-party experts.
Well, given the new regulation from SEBI on OBPP platforms, are you planning to move towards that regulation? Are you at least exploring to how do we get it done?
Thinking about it, I mean, so there are two parts there. I mean, of course, we ensure that basically when the funding is happening, it is entirely happening by us. So we don't really pool any money, collect any money to invest into any opportunity or none of that sort. We only sell an opportunity when we really have it, right?
Sure.
We don't do any kind of primary subscription or advertise for any primary subscriptions on Earnnest, right? I think the basic thing is that as you go, as any kind of a sector evolve, and I think it is imperative for India to create such larger bond markets. And for creation of those larger bond markets, it is also kind of important that you're creating market both for unlisted bonds and listed bonds, right? And you also prepare the sectors to move towards listed bonds, etc., which we are doing. We're kind of working on those legs, and as and when there is a little bit more readiness, maybe we will also create a OBPP platform.
Sure. Okay. Got it. I think some of your competitors are selling real estate debt as low as 1 lakh rupees. And you did mention that, by design, your platform puts a minimum of 10 lakh rupees ticket size. So I want to ask, who is, let's say, an ideal retail investor, or who is an ideal investor for you who should come and, let's say, invest on the platform? The reason I'm asking that is because maybe 1,000 people will watch this podcast, and I don't want each and everyone who doesn't or can't handle that kind of risk to come onto your platform. So getting that segmentation from you will help them.
So I would say there are two aspects to it. Honestly, handling that risk is our job, right? I mean, we are very, very clear. If you invest to the best of our capability, we want to ensure that whatever has been promised by that NCD, that gets delivered to our investors. So now the platform has been operating for, 2.5+ years. Every single interest payment is on or ahead of time. Every principal payment is on or ahead of time. All the deals that we did in 2022, right, they are already 100% exited with the return that they promised, right? Few other deals are already 50% exited, right? So all of those kind of parameters remain, right? So the way to think about it, is it like a risk? Is it risk similar to equity market? Answer to that is absolutely no, right? There, the risk of volatility is much higher. What return you will make is much less clear. Is the risk same as FDs and AAA bonds? Clearly, no, it is higher. People should be cognizant of that. And that's where our expertise come in terms of mitigating and managing that risk. So I think you should certainly look as an investor, you should certainly spend time looking at the profile of the team and get comfortable with it, because ultimately you're kind of backing them in a certain way. The second thing which is very important for me, and I will always look at it if I'm going through any platform, is that platform as an organization or a team investing its own money in it or not. And if they're not doing that, for me, it's a big red flag. I will just not do it. The skin in the game is a basic principle of any kind of, investing activity, right? Sure. So we are very, very clear on that. We put a very high credence to that, and we are putting that money, right? So my point being that ultimately, yes, every investor needs to go through its own risk appetite assessment and all that. But in our mind, it is less about not doing it. It is more about allocation. And as India evolves in the fixed income market in general, I think investors will be well served if in their own way, whatever risk, whatever portfolio allocation they can do, they start experimenting with this. because, otherwise you may completely miss out an asset class which can significantly enhance your return and also provide you regular cash flow. So, I mean, it's a fantastic way of generating passive cash flow with minimum amount of inconvenience. Like even if you were to go and buy a rental property, you got to go through a lot of hoops, register it, manage the tenant and all that. So that was kind of very easy. Now, who should do it? So one, clearly we have deliberately kept ticket size a little bit higher so that people who are a little bit more ahead in their journey, have some experience. I would genuinely recommend, if you are an absolute fresher, maybe just doing equity mutual funds is probably your best thing. And whatever liquidity you need, maybe you have a long way, you have time for creation of that growth. You may not need that much passive income early because your obligations are not that high. You're not doing your retirement planning from a cash flow point of view, etc. We see a lot of people who are later in their years, they want more passive income. They want to, start building that corpus. Many people also come, they want to put in an X amount of money, and then the lot of return that come, they deploy that in SIPs in equity markets. So at one level, you're trying to have the wealth effect. On other level, you're trying to have this thing. So I think people who are relevant is for whom a single investment size of this 10 odd lakhs is useful. I would say, think of your books as an allocation. If you have 100 rupees and you want to put 50, 60 rupees in equities, you should do that. Whatever you're not keeping in equities, outside of whatever is the absolute liquid portfolio you want to maintain from an emergency fund and all that, should really be invested into ideas and opportunities where hand on heart you feel you will make at least 10% post-tax. Otherwise, I don't think you're doing justice to your portfolio. And this part of the portfolio allows you to possibly get more current income, more cash flow, and the equity part will allow you to have long-term wealth creation, right? So to my mind, I think that's how people should think about it. They should be okay with the illiquidity of these products, though in our case, it's a tradable bond. So if tomorrow you want to exit, there is an exit that can be done.
But no, fair enough. And it all comes down to diversification. Even whether you're young, whether you're old, diversification is important. The follow-up question would be, there are so many different kinds of options now available in alternatives. P2P lending, invoice discounting, securitized debt instruments, agricultural financing, fractional real estate. Why real estate? I mean, because I only have enough money.
But I don't think as an investor, you should think about it as real estate debt or anything of that sort. Okay. It should not matter to you beyond a point. Yeah, you may have a sectoral view, right? For example, if as an investor, I am sophisticated enough and I have some strong view about a certain sector or not, I may, like if somebody is in agri business and he understands that agri space very well, he may be able to have a more informed view. But for most investors, whatever these investment options are, they may not have a very deep insight into that any which ways, right?
Sure.
I would not say that a lot of investors who are coming and doing the investment in an Earnnest product is driven by the fact that they want to do real estate debt. What they are coming for is not so much that we do real estate debt.
Sure.
What they're coming for are two things. One, okay, what is the return it is offering? And can they feel comfortable about the delivery of that return by virtue of the team that is doing that business and the alignment of that team in that investment? And if they develop that comfort, he is interested in making that 15% return. Now, whether an agri bond is doing it or a real estate bond is doing it or something else is doing it, as an investor, it should not matter. Then the only other thing is, okay, between an FRE and this thing, this is a fixed 15%. There is no debate around it. On FRE, yes, you are taking a view, okay, where the markets will be. So you need to actually have a more nuanced view of that appreciation. And also the fact that a large part of your return will happen in future, not along. In our case, the entire interest is actually paid on a quarterly basis.
Got it. Okay. No, makes sense. One last question would be, are NRIs allowed to invest in the bonds that you bring onto the market?
Not right.
No.
I mean, you are allowed in listed bonds, but right now the bonds that are on Earnnest are unlisted bonds.
Oh, I thought they were not allowed in listed bonds because of their OBPPs can't really onboard NRIs.
So I may be wrong because we have not kind of gone through that in detail, but I don't think their NRIs are allowed. We check for our specific thing; they are not yet allowed.
Okay. Okay. No, because
You get in AIF also, where NRIs would be allowed.
Okay. So Ashish, again, sorry, one last question. I know I've taken too much of your time, but let's say if somebody wants to buy a bond, and I think there's one opportunity live on your platform, which is a 4A opportunity. What kind of security covers are, available in this bond? How you as a platform will also monitor whether the developer is doing what they're supposed to do, or do I need to, dip into that security features? How does it all work operationally?
So when we are doing any new investment, typically speaking, we are looking at cash covers of anywhere between 2 to 3 times. What that really means is that when we do an investment, we create a charge, mortgage, hypothecation on receivables, etc., on the underlying security. And when we say cash cover, what it really means is whatever is the cash flow anticipated to be generated from that underlying security divided by the principal that we are investing, right? Okay. And that number we typically keep between 2 to 3 times. So it gives us a lot of margin for error, first of all, right? Okay. In general, there should be no need to kind of get into any security measure, because by and large, whatever investments that we do, they are self-liquidating in nature, because people sell the residential project, that money gets converted into cash flow, comes back. And we kind of, and all of that is managed, as I mentioned earlier, through an escrow. So it cannot go out, it can go for the construction of the project, or it can go to pay us down, right? So I think so. And then we generally have personal guarantees also, corporate guarantees also, pledge of the shares of the SPV also. So a lot of various different measures in place to keep the interests aligned, right? So that is what happens. In terms of, so that is all monitored on a very regular basis. Investors get a full quarterly report where they can just log into their portal and go to the portfolio section, and they will be able to see everything about the project progress, about a quarterly report which gives them an update about the sales and the construction, progress photos of the project, also how their own investment is tracking, what money has been returned, how much interest has been given, what TDS has been taken, etc., everything. Okay. Right. And everyone also has a relationship manager, so if they have any queries, they can just reach out to that person. Sure. So that's kind of how it works. In terms of actually somebody going and doing something, that's also very simple. You just go, you register. If you need any assistance, our team is there to help you walk through the process. Sure. There's a one-time KYC process, and then you can just go ahead and involve the click of a few buttons.
Okay. I'm going to ask the question of the charge. So you create a charge on the underlying project, which is around 2 to 3x. But that project is still being developed, right? It's not yet fully constructed, which is why the construction financing angle comes. Right. What if the developer just takes in the money? And I know this will be solved by your due diligence, but what if they just take the money and do some sort of fraud, they run away? What kind of security measures will get taken? Because the project is incomplete, right?
But they just can't do it. The point is, the money is funded into an escrow account. Generally, we use like HDFC Bank as an escrow account. Any release of that money, not only, of course, there is RERA, which also mandates certain escrow provisions, but even beyond, like whatever is released even from a RERA escrow account goes to another escrow account. And that escrow account is controlled by the debenture trustee. And any money that is released from that escrow account is released after verification of the invoices by a third-party independent expert, and goes for the construction of the project or for repaying the. So the developer in itself, in most cases, cannot just freely use that money and do what it wants.
Okay. That makes sense. Makes complete sense. I think we have covered it all. One last thing that we try and ask all our guests on the podcast is, because you are from the investment domain, you know so much about managing money as well. How do you manage your own money? Like, what sort of allocations do you have? And what are some of the tips that, these retail investors can get from you?
So the way we manage our own money are 2-3 basic principles. We maintain a small emergency fund, which is liquid. But outside of that, I have a very clear thing. Anything that we are investing into from a long-term perspective has to generate a minimum of 10 to 12% post-tax. So I don't keep any single penny in either a FD or a mutual fund, that mutual fund outside of an emergency fund. That's point number one. then we generally keep about 65% allocation into equities, which is for longer term goal. And the balance 30 odd percent allocation is into opportunities which are non-market linked, produce cash flows, and will give me 10% plus post-tax return. So today, a lot of that allocation, to be honest, is going into Earnnest deals. I mean, we know the best we are producing that. We also align ourselves with the investors. In between, I mean, we look at REIT prices when they are at an interesting point where I'm getting a dividend yield of at least 6 to 7% post-tax.
Yeah.
It's when we try and buy them, also married with the view of return. So we are always in search of limited opportunities. We don't try to do too many of them, but limited number of opportunities where we have comfort, which will give us that return.
More perfect. I think but you are doing what you know best, which I think retail investors should also focus on. We keep it simple wherever possible, but when the need arises, have some form of diversification and portfolio allocation, but a healthy one based on where you are in your career. So again, thank you so much, Ashish. I learned a lot about real estate debt. For me, the most interesting part is the security asset, because I have seen even your platform and other platforms always mention 3 to 4x security cover, but I have personally never understood what that security cover means. How, will I get that if a default happens? So really want more about that. Real estate debt is an exciting segment. Debt altogether in India is a very exciting segment, because as and when that money revolves internally within India, Modi ji saying अगले 10 साल India के 10 साल हैं is get realized, because if there's no debt, there's no financing for the underserved areas, that money will not move on growth. So very excited about the debt market, where this will go. Real estate debt being a much more alpha generating option. I'll definitely check out the opportunities on Earnnest as well. So thank you for that. And for our viewers as well, you can check out Earnnest. I'll mention the link in the description. And, for any questions, I think they have a fantastic relationship manager team. You can reach out with them as well. So thank you, Ashish.